Hi, everybody. It's Lynette Khalfani-Cox, the money coach.
And Teri Ijeoma, the founder of Trade and Travel.
And this is Make It Make Sense, the show that breaks down everything you need to know about different investing topics.
Yes, and today's topic is asset allocation.
So, what is it? Well, to explain this investing concept, it might help to start with an analogy. If you were about to take a cross-country driving trip, chances are you'd want to have a GPS in your car, right? I know I would. Or maybe if you are trying to keep it really old school, you might want to have, say, a physical map in your vehicle. That's something my husband Earl would do, I'm telling you right now, okay? He would. But you know what? Just like you wouldn't want to drive from, say, Las Vegas to Louisiana without a road map, you also shouldn't invest without the benefit of having an exact set of direction as to where you're going. Unfortunately, that's exactly what millions of investors do every single day when they invest without having a clearly defined asset allocation strategy. So think about your goals and what you'd like to achieve. Maybe it's paying off debt. Been there, done that. Or maybe you want to buy a house. Maybe you want to start a business or just amass a certain amount of money for your retirement savings. Whatever your goal, that represents your final destination or where you want to go. Your asset allocation strategy is the roadmap that guides you there. Here's how. Asset allocation takes into consideration your current age, your investment time horizon, your ability to stomach risk, and your goals. And based on all those factors, you determine, or a professional helps you to determine, the best mix of investments that will help you to achieve your objectives and sleep at night without worrying about your portfolio. So, asset allocation is really just a fancy Wall Street way of saying the mix of investments you own and how everything is divided up on a percentage basis. Here's an example of how you might allocate your money. You could put 70% into stocks, 20% into bonds, and 10% into cash. So let's say you had $10,000 to invest. You'd allocate $7,000 or 70% of your money into the stock market. Another $2,000 or 20% of your funds would be put into the bond market. And then the remaining $1,000 or 10% would be kept in cash, maybe in something like a money market account, very liquid, easily accessible. With this kind of asset allocation mix, you've built a moderately aggressive investment portfolio. Now, some people might want an even more aggressive portfolio. I do. I tend to be really aggressive. Say with more stocks. But others might favor a more conservative strategy with higher allocations of bonds or maybe more cash in the mix. That's what asset allocation is. The idea is to build a suitable portfolio for you, one where you establish target percentages or even percentage ranges, and then you invest money in different asset classes to reach your goals. One big benefit to doing this is that you systematically diversify your investments. In fact, this is the single biggest argument in favor of asset allocation. Did you know that research shows that 90% of portfolio performance is determined by asset allocation? And that's because when you practice prudent asset allocation, you're diversifying your investments. Now, take a minute and think about what that statement means. For those of you who are investing over the long haul, like me, your ability to multiply your wealth by investing is not really based on what individual stocks or bonds you buy. And it's not dictated by whether you pour your money into one sector versus another. Making money over time in the world of investing is chiefly determined by how well you divide up your money into different types of assets. Now, you can certainly trade in the short term and make money, good money, in fact. So if you practice good trading habits and you learn a trading system that works, you can even beat the odds and trade successfully over time. But it really doesn't matter whether you're a day trader or a swing trader, someone getting in and out of positions over a few weeks, a few months, or even somebody taking a long-term approach and holding over a few years. Whatever the case, if you learn about asset allocation, you'll be better off than the vast majority of investors out there.
And here's why that matters. Having a predetermined asset allocation plan is crucial for several reasons. For starters, with a proper asset allocation plan, you'll be less tempted to buy and sell on a whim. In other words, having a plan helps you control your emotions. And I talk about that all the time. Having a trading plan helps you control your emotions, and having an asset allocation plan also does the same. And how many times have we let our emotions get the best out of us when investing in stocks? Probably more times than we care to admit. An asset allocation plan also improves discipline and consistency in your investing efforts. That's because before you make a trade or buy a particular investment, you'll be measuring that investment against everything else you own. You have to see whether it actually fits into your overall investing game plan, including your asset allocation strategy. Also, an asset allocation plan reduces risk, since no investment strategy or category performs well all the time. For example, you may have some assets that do really well, like small caps that are growing, in favor right now, while other large caps are not, or vice versa. Sometimes there's a rotation, and then those stocks trade places. Maybe now the small caps are not doing well; they're out of favor, and the large caps are doing well. Nothing performs the same all the time. So that's why it's really important for you to have a proper asset allocation strategy.
So now let's give our audience kind of our 2 cents, right?
Yes.
Our experience in this area and just our kind of thoughts about it. So, we've talked about me being more of a long-term investor and you being more of an active trader.
Yeah.
And so I've applied over the years asset allocation in my investing strategy. And I'm a big believer in it. I totally believe, and I see how it's helped me. But the more and more I learn about trading, I'll tell you that I understand that for some areas of investing in the market, you don't have to be as concerned. So maybe we talk a little bit about that.
So I think right now, like, one good thing we can talk about is just like, what is my asset allocation mix?
Right.
Because yes, I'm a trader. Yes, I love day and swing trading, stocks and options, but I also invest in real estate, and that's another way to diversify assets. I also invest in some like Bitcoin and crypto things. By the way, if anything ever says Teri and Bitcoin, I do not teach that. Don't look at that.
That's somebody fraudulent out there trying to capitalize on your good name.
There, right?
Yes.
Because all the pretenders be like, Teri, Bitcoin miner. No,
you're like, no,
I
that's
only
not
do
me.
stocks and options.
Yeah.
But in my asset allocation,
Yeah.
yes, I have put some into crypto, some into real estate, some into long-term or swing trading. I don't really have a lot of long-term trades, but I will say the 30 companies that I watch, basically those are my long-term investments. I just trade in and out of them so that I'm getting money over time, but consistently making income.
Oh, that makes sense to me. That makes sense to me. And I would say in my portfolio are about 30 companies as well. But it's not just individual companies. Some of them are funds, some are ETFs. And then so I'm kind of buying a category or a sector or stuff like that. But even across that lines, I'm trying to get diversification.
True.
I think it's also important when people are thinking about asset allocation to just kind of hone in on the purpose, of course, being reducing risk, as we said, and having diversification, because that's a good thing. You never want to put all your eggs in one basket, just like you teach your students about knowing the size of a position to take.
Yes.
Like, don't just go out there and say, oh, I got $10,000 to invest. I'm going to put it all on this, on this one thing. That's not prudent. But when it comes to diversification, I do think that sometimes people think that, oh, I'm diversified because I have 7 different stocks or 10 or 20 stocks. But no, you're
all
not really
stocks.
diversified, right? If every single thing is all tech or
Yeah.
all, pharmaceuticals or all transportations or all retail, and I don't know who would be buying all retail right now, but
But I do have some people that they just don't know, so they don't realize that retail's not performing well. They just think,
Wow.
oh well, I go to JCPenney's, and like that's one of the worst ones to get. But I shop at JCPenney, so I'm gonna get that stock. Like they don't realize.
Yes.
That's true.
Yeah. And or maybe some of them are thinking that so-called reopening trade of just, the economy is coming back. We have a robust economy. Vaccinations have been delivered, thank the Lord. So, but I think that in general, people should think about these in different categories. Like when I'm looking for my asset allocation strategy to be prudent and I'm thinking about diversification, I'm looking at geographic diversification. So I'm not going to be focused exclusively on U.S. companies. I'm going to try to get some international exposure in that as well.
Yeah.
I'm going to be looking at I'm going to be looking at diversification beyond geographic diversification in terms of sectors or industries. So I don't want to be all heavy in, say, just bank or just fintech, because I happen to like fintech and 3D stocks, as we were talking about. I love pharmaceuticals and biotech stocks as well, but I don't want to make all my money.
It's good to have a little bit of food, a little bit of tech, a little bit of healthcare, a little
Absolutely.
bit of consumer discretionary.
And then what you mentioned, I think is super important to think about size of an investment or companies that you might invest in and style. So value versus growth. You might want to have a little mix of both to protect yourself, right? Or you might want some small cap, some mid cap, and large cap offerings in the mix as well. So all of that can help you on the diversification front, and that all rolls up too when it comes to thinking about prudent asset allocation.
Yes. I think a good example of this happened even with 2020. During 2020, there were several stocks that did really well, while there were other companies that fared poorly. So, for example, tech did really well during COVID. You had Teladoc and Moderna, all the things that did well during COVID. Like those stocks were skyrocketing, and they
Even
were like the
Zoom,
stay-at-home stocks.
Right, the stay-at-home
Yep.
stocks, Zoom, etc., because everybody's working from home, that kind of thing.
Netflix, DocuSign did really
Yes.
well. And then all of a sudden, when the vaccine started coming out, all those stocks started to go down. But now, all of a sudden, the airlines are coming back up because now the reopening stocks are in favor.
Yes.
So it's really good to be diversified so that we can have some balance when certain stocks are not doing well, the others will.
And didn't our mothers, grandmamas, relatives, anybody with like 2 cents worth of wisdom always tell us, don't put all your eggs in one basket,
Yes.
So really that's at the heart of what's driving the need and the purpose of asset allocation. So what else? We should talk to folks about how they can get started, I think, as well.
Yeah. So, and I'll kick it to you, but I know one thing on getting started is it's important to actually research and know different sectors. Like even as I think about, we probably have an episode coming up with ETFs. Like there's so many different sectors that people can look at, from healthcare to finance to technology. But first, getting aware of those sectors is good. And then going into, okay, well, now that I know the sectors, what can I invest in this sector? And putting some different things into your portfolio.
Doing the homework, you got to put in the work, know. It's important to start to research and investigate different asset classes.
Yeah.
Because a lot of us, again, some of us, a little older than others maybe, you kind of started off with the 3 main asset classes. You had your stocks, your bonds, and your cash. But you know what? There's a whole host of alternative investments now. There's obviously cryptocurrencies, emerging Bitcoin as an asset class.
Yep.
There's commodities. There's real estate.
Yep.
So of course there's other asset classes, private equity in the mix, etc. So there's a lot that you could research and find out about.
And get into, yes.
And and so when you're looking at the overall mix, which is what your asset allocation is, you might say, I'm going to put a little bit of money into real estate.
Yes.
I'm going to put a little bit of money into, say, Bitcoin.
Yeah.
I'm going to put some money into commodities. And then you kind of allocate it accordingly.
Agree. And it's important, too, to think about the interest rate and the return from each different asset class. And think about, like, how long you're planning to hold it. So, for example, if you get into real estate, then your return may be, 8 to 10% or...
Yeah.
Like, I know that's kind of like if you got into the overall market, it averages about 8 to 10%. But then you think, okay, I'm going to be in this real estate investment and it'll take me this long to make this return. Then you look at the next thing and you say, okay, I'm going to get into this type of investment. It's going to make this return and I have to hold it for this long. Like, those are things that you should be thinking about in your asset allocation plan.
Right. And you're going to be looking at the overall averages and what it all works out to. Because, again, some people might be more conservative. They might be like, I'm going to keep this amount in bonds or in something that's, quote unquote, safer.
Right.
Now, again, as you're thinking through some of these strategies, don't be penny wise and pound foolish, okay? Because sometimes people say, oh, I want to put my money here. They practically want to put the money under the mattress.
Right.
And it's like, okay,
part.
well, if you have some bonds or even keeping it in cash, are you really doing yourself a disservice because of inflation, right? The value of your dollar is being eroded every year by rising prices.
Yeah.
So if it's, say, 4% inflation, a dollar today is only going to be worth 96 cents next year. So it can't buy as much for you. So you have to invest in order to outpace inflation at the very least.
And I was explaining that very same concept to someone earlier today, and it was the idea that in, like, let's just say Dallas. In Dallas, you could get an apartment you could get like a 2-bedroom apartment for $800, $900 just a few years ago. Now that same apartment is $1,600. Like, you can't get anything less than $1,000. That's what we mean when we say that the value of your money won't get you as far down the road.
That's right. And that's one of the reasons why people need to invest for growth and make sure that that's a component of their asset allocation and their overall investing strategy. So we hope that you guys have learned a lot from this. I'm going to give you one last tip because Teri actually teaches a super awesome course on investing called Trade and Travel. And her VIP section of the course in particular gets you into some of these other asset classes like options.
Yeah.
And so I think that for those of you who are interested in having a prudent asset allocation strategy and learning how to take your investing to the next level, I'd recommend you check her out. It's Trade and Travel. That's the name of the course. A little plug for you right there.
Thank you. Right.
You're my sister. I got to look out. So with that, we'll wrap it up and we'll see you guys in the next session.
Yes. We hope we made it make sense.